Thank you for coming to hear me speak on St. Patrick's Day. Could be really fun. I told Scott, I said, they're probably all going to be drunk, so the presentation is going to go really well. So either you will be or maybe I will be by the end of this presentation. So I've broken up the presentation today in different parts. First is some bargain hunting wisdom from my uncle, Sir John Templeton. And then secondly, we'll go through an overview of the bargain hunting process. And then I'm going to take you through some of the major market corrections over the past 100 years. And then finally, through a real life example of one of the investments we've made at our company so you can understand our investment process a little better. So I like to start with these quotes because it's just a great reminder of the Templeton philosophy. Sir John was my great uncle, and I grew up with him on Wall Street Week and all these, as I was telling some students earlier, the language of business was spoken in my house as a child. So they had me investing really early, and I grew up with him teaching me investing. But one of his most popular quotes is, "A major cause of higher prices is higher prices. But when the trend is reversed, then lower prices lead to still lower prices. To buy when others are despondently selling and to sell when others are avidly buying requires the greatest fortitude and pays the greatest ultimate rewards." Secondly, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. An investor who has all the answers doesn't even understand the questions. And if you want to have better performance than the crowd, you must do things differently from the crowd. So this is our process at Templeton and Phillips Capital Management. It's probably very similar to what you've heard from some of the other value investors that have come here to talk to you. We use some valuation screens that are pretty standard in our industry. We use Bloomberg to download bulk data, and we have these screens built, and we look at them every morning when we come into our office. They're everything from low P screens to low PEG screens, low price to book, low price to cash flow, very standard valuation screens. And what we're focused on when we look at those screens is the bottom decile of the market. And I can tell you from doing this for now many years, I turned 40 next week, and I started my company when I was 24. But for doing this for many years, I can tell you that you see the same stocks in the bottom decile over and over again. So if you're looking at these screens every day, occasionally you'll see something new pop up that is curious. And value investors should be very curious because you've got to be a digger to be a good value investor. So that's where our process starts. When we find something that captures our attention and we want to dig a little more, we typically model it. We're generally using a discounted cash flow model under 3 different scenarios. We're equal weighting those scenarios. But sometimes we'll use a dividend discount model. It just really depends on the company and the industry we're looking at. But basically, we're trying to find a company that we think has 50% upside to our approximation of intrinsic value. And that is our caveat for employing capital at our firm. If we cannot calculate 50% upside to intrinsic value, we won't place client capital at risk. Some students asked me earlier, well, where's the 50% from? And Scott and I just kind of stared at each other and we're like, I don't remember. It's just been that way. At some point we came up with 50% and it's worked well for us, and that's how it is in our company. Now, my uncle always had a philosophy that when you find an attractive value investment, but you have a portfolio that's already well invested, that you should only sell a stock and buy a new stock if the new stock is 50% better. And that was one of his rules that he looked at. He used a variety of valuation metrics. As we were talking earlier, he said he had hundreds of valuation metrics he looked at. He was very flexible in his investment process. I can tell you from knowing him personally that he did not benefit from Bloomberg and bulk downloads from Bloomberg. He was taking Value Line, and he was pen and paper making a list of stocks, and he was ranking them by hand to find where the stocks were with the lowest value ratios or metrics. If he found a consolidation of stocks, let's say in Japan, it would lead him to do some more analysis on Japan, and you might see him come out on Wall Street Week and say, I'm investing money in Japan. People often think of him, or confused and think of him as a macro investor, because he would come on TV and make these statements, but that is not what he was doing. He was ranking stocks based on valuation metrics, and if he found a group of stocks trading in a country, it might lead him to focus on the country. But that's how he did things, and he was always impressed. I remember one time I went down and he said, well, I really think you should go back to your office in Atlanta. I was at the time. And he said, and could you, take all the stocks in this one country and could you just rank them on this PEG ratio for me? And I said, yeah, give me 30 seconds. And we went, out of the room to where the computer was and, plugged into Bloomberg and ranked the stocks and printed them out and handed them to him. And he was like, what? This is crazy, because he was so used to doing things by hand. He had no idea how quickly you could get data these days. And so I was telling the students earlier that I would much rather have been a value investor when he was, because he believed in the doctrine of the extra ounce. He was an incredibly hard worker. He was very disciplined. And you had to work a little harder then to get the information and to get the valuation metrics. It wasn't so easy. And so now it is easy to download all this stuff from Bloomberg. So it's a really hyper-competitive space, I feel like. And it's sometimes harder, in my opinion, it's harder to be a value investor these days. I would much prefer the environment that he worked in. But if we calculate 50% upside to our approximation of intrinsic value, we then go on to do fundamental analysis, which might mean calls with management. More likely, it's a call with a competitor or other players in the value chain. We get the best information from competitors. My husband, who's actually runs the investment research department at our very small company, was a sell-side analyst. So we don't rule out calls with management. It's also not a requirement to have a call with management. We're very cognizant of the way management can talk to you as a potential investor. But there are important things you can learn from a call with management. We were saying earlier that specifically the way you can tell sometimes if they're very myopic or they're very long-term in their vision for their company and thinking, and that's very important. But we get the best information from competitors or other players in the value chain. And then lastly, if the stock has passed all of those tests, it's in the bottom decile, and on our screens, if we've calculated 50% upside to intrinsic value, we've done the fundamental analysis, we've done the industry analysis, we think this is a great holding, we then look at our portfolio and say, does it earn a spot in the portfolio? Do we have cash available to invest in the company? We also look at country exposure. We look at industry exposure, currency exposure. So we look at all of those things to see if the company deserves a spot in the portfolio. At our company, we always say that there are 3 sources of alpha in the market. The first on the left is exploiting information. This is where most investment managers play. So this is the ability to have better information than the next person, to gain an edge through information, leading to more accurate earnings estimates. This is a really hard space to be in. And I think one that, we're not that great at playing at. First of all, I don't look great in stripes, so I don't like going anywhere near inside information or anything like that. This is not an area where we really focus on as managers. Secondly, you can build a better model or process. Think of quant shops like D.E. Shaw and Renaissance Tech. That's not an area where we play either. And lastly, a source of alpha is to exploit behavior. And this is really the hunting ground for value investors. This is where value investors should play. Human behavior is very predictable, and this is where we gain our edge as value investors. So we've talked a little bit about our process at my company. Now, what I want to tell you as students is you're all sitting here and you're studying this in textbooks. You're reading about it, right? You can build a discounted cash flow model. You can rank stocks. You can look at metrics. You can read all sorts of different reports. You're interested in investing. You want to do it. You all want to manage funds, right? I'm guessing you all want to manage some type of fund. Most do. But I don't think that most of you will be very good at it. And the reason is psychological. I don't think that most of you in this room have the ability to do it. And I just want you to be really open-minded and humble when we walk through these next slides, because it's important. It doesn't mean you can't work in the value investment industry. You can go be an analyst for somebody. But I think it's really critical that you ask yourself, do I have the personality to do this? Can I handle it? Because if you don't, then, maybe you need to redirect yourself. You can still work in the value investing community. You can still play a huge part in that, but maybe you're just not a portfolio manager. Maybe you're not a fund manager. But so be humble, and I want you to use your imagination and be very honest with yourself. So I'm about to walk you through some slides of some of the big market corrections that have occurred over the last 100 years. I want you to imagine that you have worked very hard and you have saved and you're worth $1 million and you have invested it in the stock market. Okay, you've held lots of jobs, you've saved, you've invested capital, you've done everything right. You have $1 million that's in the market. This is the first slide. So this is the stock market crash of the Great Depression. Okay, it lasted from 1929 to 1932. Your $1 million has lost almost 87% of its value. Now, you might say, yes, I've read about that. The conditions are, all of that was very obvious in hindsight. But even Benjamin Graham took some heat in this one. I mean, he lost a lot of money in this crash. So I'm asking you, if you look at the bottom right-hand corner, you've had $1 million. You've had it invested. You just lost 87% of it. Are you ready to go buy stocks? Are you going to do it? My guess is that most of you won't. This is the 1970s bear market. So this was very interesting because social spending from the late 1960s did so much damage to the budget that the Nixon administration had to release the peg to Bretton Woods, which was a de facto gold standard, and inflation set in. So during this time period, you had inflation, you had a recession, you had an oil embargo, there were gas lines at the gas pump, there were price controls. That is your environment. Your $1 million has lost almost half of its value. So you've been invested in the market, you've lost half its value, you've got this huge inflation, you're in the middle of a recession. There are lines at the gas pump, there are price controls. Are you ready to buy some stocks? Are you ready to go out and do it? Or are you scared? 1987, This is one I remember very well. I was 11 years old. The Dow corrected 22% in one day. So in one day, you lost 22%. Now, I'll tell you, my father, who was an investor his whole life, but I grew up in a hardware store is where I grew up. My dad he owned a local hardware store. He was very good at business, and he knew it was really hard to make money. So he was smart. He got all of the money away from the business. He paid himself first. He and my mom saved 50% of everything they made, and they invested, and they became students of the market. And he and my mom sat around and studied investments. He eventually sold his hardware business, and he went to a town about an hour from ours. We live in a very small town in Tennessee. It's where Sir John is from, too. And he said, I will come work for you at this brokerage firm for 2 years if you give me all the training you can, but then I'm going to leave. So he took a job at Dean Witter Reynolds, and he was working the day of the 1987 crash. He was the only buy order in the whole firm. And on that day, he saw veteran brokers get up from their seats, leave the office, and he never saw them again. They didn't even bother coming back. They had lost so much money, either for themselves or clients, they just walked out the door. On that same day, down in Nassau, Bahamas, my uncle had a very, he exercised every day at 11 o'clock. That was his big thing, is every day at 11 o'clock, he went and walked in the ocean for an hour. And it was a routine. He did it every day. A lot of value investors have some things they do like that. And it's, I think it's great. But every day at 11 o'clock, he would go exercise. So on this day, when the market was correcting, Mark Halowesko and Marty Flanagan, who are great value investors, I know you know them, they manage, Marty Flanagan's now the CEO of Invesco. Mark Halowesko manages a hedge fund down in Nassau, and he managed Templeton Growth Fund when my uncle retired. So these are really good investors, but they were young. My uncle had a history of hiring people when they're very young. And it was it was on this day, and they came running up to my uncle as he was leaving to go walk in the ocean. And they were like, where are you going? Where are you going, Sir John? Don't you see what's happening in the market? And he was like, I'm going to exercise. So he goes to exercise, and he comes back, and they come running up to him. Oh my gosh, you will not believe the market. It's down 22%. And he said, boys, sit down now. He said, I have good news and bad news. The bad news for you is we're in a bear market. The good news is it's almost over. I want your recommendations on my desk on what stocks we're going to buy. And so that day, he was calling over orders to the office in Fort Lauderdale and to his brokers. And to this day, some of the brokers that took those orders tell us about it. There were not many orders that went in on that day. So the market's correcting. It's fallen 22% in a day. Are you ready to pick up the phone and place an order for yourself or for your client? That's what it takes to be a good value investor. And so many people can't do that. We have people come interview for us all the time, and they say all the right things, and they've read all the right books, and they know how to model a company, and they know all about value investing. But when the rubber hits the road, they can't do it. They psychologically can't do it. This is the dot-com bubble and crash. Actually, I just started working at Morgan Stanley. During this, I remember it very well. And leading up to it, I went down to Nassau, and I was having lunch with Uncle John. And I was like, what dot-com stocks are you buying? And he was like, oh, God, have I taught you nothing? And he walks through all the bubbles he had seen in his life. So he said, Lauren, when I was a little boy, my brother and I would walk from our house to the town square in Winchester, Tennessee. And there was a house, and we'd all go stand in the yard. And everybody else would come and stand in the yard. And the owner would eventually come out and wave to everybody and go back on in his house and flip a switch, and lights would come on and light up the house. And that's what we went to see every night. And he said, I've done some analysis, and the time to get out of those stocks was 2 years prior to that. So he walked me through electricity and automobiles and color television. And then we got to, the tech stocks. And he was actually shorting these stocks. So he had devised a strategy where he was shorting these stocks about 7 days prior to IPO lockup expiration, because he believed that even the insiders or the owners of the company knew that their company was not truly worth what it was selling for in the marketplace. So as soon as the IPO lockup expired, they would dump the shares. And so he would put on the short about 7 days before it. He would cover it about 10 days later. And I think he made money in almost every one. I can't remember exactly anymore. It's been so long. But he made a ton of money with that strategy. He recommended the strategy to my dad. My dad tried to do it, and he couldn't stand it because those 7 days were hard days. Shorting a stock back then, a tech stock in those days, was kind of like standing in front of a train and staring it down. You're playing chicken with the train, and it was a very difficult thing to do. So, but this correction, you would have lost 50% of your net worth. So, are you ready to invest at the bottom of that correction? And then lastly, here's the 2008 financial crisis. I hope that you guys remember that. I don't really know the age of everyone in here. I certainly remember it. It was, it was a hard time to manage money. We definitely turned off the TV in our house. It was too hard to watch it. But, you had Lehman just disappeared, right? Fannie and Freddie were insolvent. They were seized by the government. So banks had to be recapitalized. The money market funds fell below $1. Companies like GE were getting shut out of capital markets. Barges couldn't even come to port because they couldn't get the letters of credit they needed. That was the environment then. Okay, from 2007 to 2009, if you had invested, you would have lost almost 60% of your capital. Are you ready to invest? I remember that very well because we started buying stocks through the whole crisis we were buying. And my daughter was born on March 10th. The bottom of the market was March 9th. And when we were in the labor delivery room, we had the laptop out buying stocks. And the nurse was like, put it away. And I'm like, get the orders filled. Things were so dirt cheap, it didn't even bother me that we were buying stocks in the delivery room. But we had been buying for months before that. We didn't know when the bottom was going to occur. We just knew that things were so ridiculously cheap. So if you're going to be a good value investor, I love what Tom Russo said. I don't know if you were at his speech last year out in Omaha, but he said, good value investors have the capacity to suffer. Do you have the capacity to suffer? Some people don't. So it's a question you need to ask yourself. Do you have that personality? Can you handle this? Now, I will say that you can learn to be a good investor, right? You have to suffer some of these painful events in the market. You have to do the right thing, put capital work, and reap the rewards from that. And if you do that enough times, it's kind of like Pavlov's dog, right? You start anticipating the reward on the other end. And so you can condition your brain to be a good value investor. But it is a painful process, one that I've been working on for many, many years. I think everybody continues to work on that. We look forward to market corrections. We really do. When something nasty happens in the market, we run in. And if it's like a dog food crisis, I'm coming in. What screens can we pull? How can we take advantage of this? Where can we make money here? Swine flu crisis, we did really well on. That was a crisis anyway, it's a long story. I'm not going to tell it to you, but, I was in the office. How can we make money on the swine flu? There has to be a way. And we ran some screens and we zeroed in on some Mexican airport operators and bought a bundle of those, and we made some good money then. But that has to be your perspective. If you do that enough times, you get really conditioned to it. But a lot of people just don't have that ability to do it. Now, these corrections and panics, as you know, are a staple to the market. Here are some of the panics and crises that occurred during Sir John's lifetime. Let's see. Do I want to comment on any of these? The Asian financial crisis was an interesting one because he had identified South Korea as a good place to invest. And he did two things to access South Korea. One, he bought Kia Motors, and he made a fortune buying Kia Motors, and was so cheap he wouldn't go buy a Kia for himself. He thought they were way overpriced. But two, he invested in Paul Matthews' Korea Fund. And, he invested on that fund. It had been the worst performing mutual fund on record that year. That's when he invested. And things were so bad for Paul Matthews. I don't know if you know him, but he's a manager out on the West Coast. He's a really good manager. Paul and his employees bought a pool table, not a pool table, ping pong table. And that's what they did during the Asian financial crisis. They played ping pong because that was important for them to do. And that was important for them to do. Sometimes in my office, I get up and leave. I'll occasionally run into somebody and they're like, "What are you doing out of the office?" I'm like, saving me from myself. That's what I'm doing. I've left the office to save me from myself. I think sometimes you do just have to get up, walk away, go play ping pong, go for a walk on the beach, go take a nap, go play with your kids. It's an important perspective to have. If you want to sit in front of a computer screen all day and trade stocks, I don't think that you're going to have great performance. If you want to be a successful value investor, you need to be able to walk away. You need to have a long-term perspective. You need to be able to separate yourself from the market and go read. So that's one crisis. September 11th was another interesting crisis. I was managing money for Sir John then, and all the markets had shut down. And I got a call from him, and he said, when the markets open, airline stocks are going to crash. Prepare for me an analysis of all the major airline companies, and I want to know which ones are the safest companies to invest in. And we decided on a number of companies, and we put in orders to buy those companies that corrected more than 50% that day. And we bought stocks on the heels of September 11th. So our calculations show that you're going to spend about 1/3 of your life in a bear market. So these are staples, and luckily for you as value investors, they're there for you to take advantage of mispricings. But the question is, are you going to be able to do it? So you either need to train yourself to do it, realize you're not going to be able to do it, and go be an analyst or something like that. But it's a real heavy component of what makes a successful value investor. The analysis part, I think, is a very small part of it. Okay, so I always show this in my presentations, Homo economicus. Do y'all know, have you heard this term in your studies? Okay, it's a term that economists use to describe man as a perfectly rational wealth maximizer. Or if you look it up on Wikipedia, it describes man as having infinite capacity for rational decision making. Do any of you think that Homo economicus lives in the real world? No. Right? Man is not perfectly rational. Often when it comes to money, he is very irrational. But most of the theories that you learn in business school, most of the models that they teach in business school assume that Homo economicus is driving the bus. And that is the flaw with so many of the theories and the models taught in business school. Capital asset pricing model, efficient markets theory. Homo economicus doesn't exist. This is a great slide we use in almost every presentation. It's a slide from Schiller, and James Montier talks about it too. But this is your value investing slide. If you take nothing else away from this talk, focus on this slide. Okay, so what this is going to show you is the present day value of dividends of the S&P 500 going back to 1860. I know it didn't exist, but they've pieced together what it would look like, and that is the black line. Okay, and the red line is the actual real stock price. So as you see, there's a huge divergence. In a perfectly rational world, those two lines would track perfectly. But they don't, okay? So actually, stock prices are 14 times more volatile than their underlying fundamentals. This is great for you as a value investor. This is 14 times more Maalox you're going to eat on an annual basis, or 14 times more opportunity you have. You depend on this. If this goes away, you can't make a living. You need this as a value investor. And human emotion creates this, right? So this is really critical to what you do as a value investor. At our company, we say that this is a pretty accurate description of how the average investor acts. So the market starts to rise, and they want to watch, right? And then it goes up a little more, and their friends make a little money. And that is truly disturbing to someone when your friends make money and you don't. Who hates that? I do, right? That bothers people a lot. So then they're like, oh, okay, I'm going to invest. So they invest. And then the market corrects. And they say, well, I've heard I'm supposed to add capital when the market corrects. So I'm going to do that. And they usually do it the first time. And the market corrects. And they're like, oh, I can't handle it. I'm going to get out. And then the market bottoms, starts to go up, and they're going to wait. They want to wait to see what's going to happen, right? And the cycle starts again. And they have really bad results, okay? And we actually, by the way, have investors that have done that exact same thing. We had one guy who followed this chart exactly. He called us and he added capital. 2 weeks later, he took it out. What was it? It was on your birthday when he finally redeemed. So was it 2012? 10 or 11. Anyway, it happened just the way this chart predicted. I mean, he called us, he gave us capital. He said, I know, we're going to, dollar cost average down. And 2 weeks later, he was like, I can't handle it anymore. I got to get out. And we're like, what? This is crazy. But you have to deal with people like that as investors. So these returns, investor returns, really show you that this behavior exists. So this is the 20-year annualized return by asset class from 1995 to 2014. So stocks annualized 9.9%, bonds 6.2%, gold 5.8%, oil 5.6%, international stocks 5%, homes 3.1%. What did the average investor make? 2.5%. Okay, inflation was 2.3%. The average investor made 2.5%. That is remarkable. How is that possible? It's possible because they're always doing the right thing. They're always putting capital in at the wrong time, and they take it away at the wrong time. I usually have a slide in my presentations, and we don't have it now, but just the records of Warren Buffett, Peter Lynch, and my uncle, which are amazing records. But Peter Lynch produced some stellar returns with Magellan Fund. I mean, I can't remember exactly what he was annualizing at, but I think he was annualizing at like 18%. So he did an analysis of what his average investors, what was the average investor making, the average investor in Magellan. Most were making less than 5%, and a lot were losing money. How is that possible? It's possible because they were giving him capital when he had a streak of good performance and taking it away when he drew down. That's how they produced those terrible results. So we always tell our clients, this is a partnership. I can manage money for you. If you're going to give me money after I've had a great streak and you're going to take it away when I draw down, we're going to have really bad results together. You've got to be able to control yourself too. And so that's another facet to managing money that you need to think about. If you're going to be a portfolio manager, you have to deal with investors like this, whether you want to or not. You've maybe conditioned yourself to pull the trigger in a really scary market panic or crisis. You've learned that you're going to get your reward at the end of the day, and you're salivating through all these market panics and corrections. But your investors may not have learned that lesson. They're calling you on the phone. They want to talk to you. They're nervous. They want to send their kids to college. Their wives, they've got their retirement on this. They want to talk to you about it. And is that going to affect the way you think about things? It might. So there's being a value investor and there's managing a value investing business. Those two things are very different, and they each have their pluses and minuses. I mean, it can be very difficult to manage investors. I was telling some students earlier that a mutual fund is almost the worst vehicle a value investor could ever manage. Right? If you're gonna start from scratch as a value investor, don't start a mutual fund, because people give you capital at the wrong time and they take it away at the wrong time. So instead of having lots of money to invest when things get cheap, instead you're faced with redemptions and outflows. And you've got to figure out how to handle that in your portfolio. And then all of a sudden you're looking at you're focused in a completely different direction than what you love, which is finding undervalued businesses, right? So, I mean, that's what it looks like to be a value manager, a mutual fund manager. That's what you're doing a lot of the time. Now, I mean, Berkshire Hathaway, Fairfax, those are perfect setups to be a value investor. Cannot think of a better vehicle. Sometimes those aren't avenues to go out and start yourself. That requires a little more capital to start a business like that. Scott and I have thought, well, maybe we could start real small and buy some pet insurers. We'd start there. But those are great vehicles to manage. A hedge fund is a little better, because if you're managing a long-short fund, right? So you're investing in long value stocks and you're going short overvalued stocks, which has its own issues that I'm happy to answer questions about. But in those funds, during a market panic, you can pull some extra levers that other people can't pull. So you can employ leverage and you can take off your short book. Both of those will get you more net long and allow you to get more exposure to the market. So those are a little easier vehicles to manage. My uncle wrote a book. Well, actually, my husband did a new edition of it called The Templeton Touch. And there's a chapter of Prem Watsa in there. There are a lot of good value investors interviewed in this book. But in this book, my uncle sat down and he made a list. He made this list himself. These were his attributes that he thought made him a successful investor. So there's self-reliance, reasonable risk-taking, sense of stewardship, a drive towards diversity, a bargain hunting mentality. And I would say to you guys, the bargain hunting mentality was a pervasive quality he had across all aspects of life. And I wonder if you guys have that. Like whether he was buying a car, a coat, a house, he was a bargain hunter, always. You know, it was like he had made $200 million on Kia Motors and he wouldn't go buy a Kia car because they were too expensive. He was a bargain hunter. I mean, he was literally like, it's too expensive for me. He did that on almost everything I can think of. I mean, he was notorious for having like holes in his socks and, holes in the bottom of his sport coats because he just wouldn't go buy one. And I asked him, like, why do you do that? You have so much money. This is crazy. And he's like, well, I save for the opportunities. But that was it was so ingrained in him. So is it ingrained in you? If you're going to be a value investor, is that your approach? Because it needs to be. It just needs to be your perspective. Broad social and political awareness. He had lots of flexibility. He devoted large amounts of time to study. He was one of the most disciplined men I have ever known in my life. My husband's very disciplined too, and so is my father. But he devoted tons of time to study. And when you would go stay in his house, you would stay in his guest house. In the morning, you would wake up, and there would be Post-it notes all over the door outside of your room where he had ideas and come and posted them on your windows, like at 4 a.m. I mean, so he was always studying. The ability to retreat from daily pressures. You hear this from so many value investors, whether it's Monish's nap room or Uncle John's walks on the beach. Mark Helewesko is a triathlete. He does the Ironman. Most value investors, when you talk to them, have some mechanism where they totally remove themselves from the market. And that's really important, especially in this day and age. Scott and I are always saying that, it's really hard to take a step back and focus on the long term right now, because through technology, people have constant access to you and they want a response right now. And so that changes your work day to putting out a bunch of fires instead of sitting around, reading, thinking about the long term. That's really important. So you have to do that. We have a house in rural Tennessee that has no internet, no television. We go there on the weekends. We're completely unplugged. We read, we swing on the porch, we play with our kids, we go jogging, and we get our best work done there. So Uncle John had an extensive friendship network. He was in many, many clubs like YPO. He is patient. He believed in thought control. He actually believed in controlling every thought in his mind. One time he told me, when I have a negative thought, I just banish it to the nothingness that it was. What does that mean? He believed in positive thinking. To be a value investor, you have to. I mean, you have to be an optimistic person. So, in simplicity, his investment strategies were extremely simple. In investing, sometimes I sit in investment meetings because I'm on some different boards, and I hear managers come in and they present these like incredibly complex strategies. I can't even understand them. I'm like, what is going on? That's a really good sign not to invest, because good investing doesn't have to be complex. It generally is very simple. And all of his strategies were. You would hear them and you're like, oh, that's so obvious. Why didn't I think of it? That was his process. And he had great intuitive powers. This next picture really just sums it up for me. This is my favorite picture of him. This is him reading the Wall Street Journal at the North Pole. So, I like the disclaimer at the bottom. Past performance is not indicative of future results. He actually was an investment manager in New York. Okay, he had an investment practice there, and he worked in 30 Rockefeller, and he sold his investment practice and moved to the Bahamas to retire with his wife. But the company that he sold his investment practice to, he had one little fund called the Templeton Growth Fund, and they didn't want to acquire it. So he just took it with him and thought, yeah, I'll just keep it as a vehicle and manage it for friends. It didn't really have very much money in it at all. And he moved down to the Bahamas to enjoy his retirement with his wife. And he worked in the attic of an old grocery store down there. Not a nice office at all, because he doesn't spend money on anything. And that's where the Templeton Growth Fund took off, right? That was the start of it all. He was already retired when he found his success. But one time I was visiting him and I said, well, tell me about managing money down in the Bahamas. And he said, it's really funny. My investment performance got a lot better when I moved down here. And I was like, oh, that's curious. Why do you think that is? And he said, well, I've thought about it, and I'm pretty sure it's because I get the Wall Street Journal 3 or 4 days later than everybody else. That's amazing. So he wasn't reacting to the news, right? He was reading the Wall Street Journal 3 or 4 days late. So that's just who he was. So now we're going to go over a specific example and to get into a little bit more meatier discussion about one of our positions and how we found it. So the conditions that were in the market when we found this. And this is a company called WH Group. We purchased this company in late 2014, early 2015. WH Group is the largest global pork producer with operations and sales focused on China and the United States. It's domiciled in China with a significant operation in the U.S., which is Smithfield Foods. This was a neglected stock opportunity. We often say that opportunities for value investors come in one or two forms. They're either neglected stocks or they're opportunities that have been created from a crisis, panic, sell-off in the market. So this was a little bit of both, but I would put this more in the neglected stock camp. Okay, so let me sort of set the scene of where the stock was when we invested. So on the left-hand side is August 2015, and it goes through, it looks like March 2015. So WH Group is a combination of two companies, Shungwi Development and Smithfield Foods. It was created when Shungwi purchased Smithfield Foods, okay? So WH Group, they decided that they wanted to tap the capital markets and list on the Hong Kong Exchange. And they decided to have an IPO. This was in April of 2014. And the company totally botched the IPO. It looks like some of you remember this. There were 29 investment bankers involved in the deal. The deal was outrageously priced, and it fell apart. So they shelved the IPO and forgot about it. And they came back and IPO'd later in 2014 with 2 investment banks and a lower valuation. We bought this company in late 2014, early 2015. The market had negatively reacted to the shelved IPO and then new IPO. So there was a lot of pessimism surrounding that, and there was a lot of pessimism in the emerging markets. So following the late 2013 acquisition of Smithfield by Shungwi, Shungwi tried to IPO the combined entity on the Hong Kong Stock Exchange in April 2014, but had to cancel the whole thing due to lack of demand. The firm reduced its IPO to $2 billion from the original $5.3 billion when it IPO'd later in 2014. Originally, the firm tried to run the IPO with a record 29 investment banks, but eventually only had 2 investment banks in the deal. Investors balked at the hefty valuation. The original IPO was priced between 15 and 21 times earnings per share. So it was on the heels of this where we went in and bought WH Group. Okay, in addition to trouble with handling of its IPO, sentiment surrounding emerging markets was really, really poor due to slowing growth rates and a strengthening U.S. dollar, with a perception of rising interest rates led by the Federal Reserve. And that's what these 2 graphs show above. Emerging market sentiment deteriorated very sharply as some investors feared that certain countries, such as South Africa, may struggle funding their wide budget deficits. Commodity-centric economies like Brazil, Russia, South Africa began to see their budgets and currencies come under fire due to sharply declining oil prices. So not only did you have the botched IPO that created real negative sentiment surrounding WH Group, but you had this negative environment in emerging markets. Emerging markets valuations collapsed during this time period to 30 and 40% discounts to the S&P 500 based on PE and price-to-book multiples. The top graph is a graph of the PE multiples. So this shows the widening divergence of emerging markets multiples over the S&P 500. And the bottom graph shows you price-to-book multiples. So there was a lot of negative sentiment surrounding the emerging markets during this time as well. Okay, so where did this leave us? This is a graph, this is a list that shows all the major global protein producers, basically, or food companies, I should say. And while running this is a screen that we would look at our office. So this is something that we would pull up in our office. This is what we would have looked at during that time period. So while running our normal valuation screens during this period, we noticed that WH Group, which is at the very bottom, you see, carried the lowest valuation of any food producer in the global markets. Now, do you guys see anything else interesting on this list, if you can read it? Like something really stand out to you? What do you see?
Despite the fact that they are the lowest in terms of PE,
It's kind of hard.
Their EV is still pretty much middle of the mark. So there's still there's value there.
Mm-hmm. That's a good point. Look at the other companies listed on the list, though, if you can read it. Does anybody see anything else kind of funny? Well, about halfway up, you see Henan Shenghui Investment and Development Company, Ltd. Okay, so WH Group had this low valuation despite the fact that approximately half of the business, Shenghui Development, was trading at twice the consolidated EV/EBITDA multiple for the combined entity. So that's unusual, right? Because WH Group is two things, Smithfield Foods and 73% of Shenghui. Okay, so we saw that and we thought, that's interesting. Shenghui is a branded high return on investment capital business with attractive growth prospects and should arguably trade in line or at a premium to a comparable business model such as Hormel in the U.S. This implies that the market was too pessimistic on the merger of Shenghui and Smithfield, or that the market was attributing little to no value to Smithfield Foods. So we found this situation really interesting and decided to dig a little further. So this is an example of a screen we pulled up in our office, something we saw, and we thought, well, that's kind of weird. Let's learn more about that. Okay, so one of the first industry dynamics that we recognized when we tried to dig a little more was that pork consumption in China was outpacing production. Okay, so that's one thing we noticed. We believe this represented a healthy backdrop for the industry as domestic demand for pork continued to be strong despite the growing pessimistic headlines that economic growth in China was faltering. In order for supply to keep pace with demand in China, domestic producers had started to import product. The growth rate in imported pork products had been impressive at 9.2% compound annualized growth rate. Since the U.S. is the largest exporter of pork Smithfield is the dominant exporter, and it was a healthy signal for Smithfield's business. So these are just some things we noticed as we were analyzing the company. So I know many of you have heard the protein story. I mean, everybody talks about the protein story in emerging markets. So this is probably just a review for you. But China's growth in protein consumption is in direct relation to its rising per capita incomes, right? As consumers increase their disposable income, protein consumption tends to show a strong correlation as consumers improve their diets. So if you have more per capita income, you eat a little better and you add more protein to your diet. It's pretty simple stuff. In China, people consume a lot of pork. It is the most popular protein. So urbanization is a large driver to this phenomena. So as people move from farms into urban areas in China, incomes tend to be 2 or 3 times higher, right? So there's this huge drive to urbanization, per capita income increases, people eat a little better. Pork is the #1 protein over there. You have a situation in China where demand is outpacing supply. So within this framework, pork was growing 3 times faster than beef and poultry. So we thought that was very interesting too. Here's a graph of hog production. So given the significant growth in Chinese pork consumption, the government had to confront some relatively serious problems in the nature of its supply base, which until recently had been very informal. So to tell you what I mean by that, as recently as 1985, 90% of hog production in China was backyard production. So, you know, a guy in his backyard with a pig. So the government stepped in to really clean that up because this posed really significant health risks to consumers and also commercial challenges to processors and packagers who wanted to achieve commercial scale. And the next slide reflects just that. So this graph shows Chinese pork slaughterhouses. So you see in 2008, there were about 28,000 pork slaughterhouses in China. In 2015, there are 4,000. So they've really cleaned up this market, or at least tried to. So beginning in 2008, Chinese government began enforcing regulations, creating licensing standards for hog production. As a result, the number of slaughterhouses collapsed by 86%. An interesting story is during this process, there were some articles, and you may have seen some of them, stories about 10,000 hog carcasses floating down a river, okay? So, the industry was just a mess, and they really needed to clean it up. So they did, but they took supply away, okay? So demand is really outpacing supply. They're removing supply. So now they're having to import supply. We thought that was all very interesting. Okay. This last slide shows market share. So despite the bad industry press, WH Group has maintained its image as a higher quality, trusted brand. And this brand image has been strengthened by the presence of imported pork from the U.S. through Smithfield Foods. The Chinese consumer is willing to pay for quality goods, particularly in light of recent food scandals. And you see that really across China, whether it's milk or, which bodes well for companies like Nestle or Danone, and they're both our holdings as well. So WH Group's dominant market share in every category, but particularly in the higher margin goods, where it possesses 4 times more market share than its nearest competitor. So you'll see that in the graph above. Importantly, with few competitors able to match WH Group's brand and image for quality, the firm is poised to continue growing. WH Group has the 4th largest consumer brand, which is called King of Kings, in a fast-moving consumer goods market above $1 billion, just behind Nestle. Okay, so this isn't just a little pork company. So this is a graph of China live hog prices and the premium over U.S. prices. And why this is important is because while most investors and analysts have focused on the selling synergies that may be possible through the combination of Shenghui and Smithfield Foods, we actually see more promise through exploiting Smithfield's strong production base. So hog prices in China have historically traded at approximately a 50% premium to those in the U.S. And this creates an opportunity for Shenghui to import from Smithfield and gain a competitive advantage through a lower cost of production and hog price arbitrage. I am from Tennessee. Smithfield was the first and remains the largest vertically integrated hog producer in the U.S. And then lastly, which I think is the most important slide to sum it all up, is just a sum of the parts analysis. All right, did I miss a slide? I think I did. Okay, so before we get to the last slide, while Shenghui gains an important competitive advantage from its business in China through Smithfield's stable, high-quality source of product, we actually see one of the most important synergies being created in the Smithfield income statement versus Shenghui. So 20% of Smithfield's income comes from hog production, a volatile, cyclical business where profit cycles were strong enough to produce consolidated losses for Smithfield. So Smithfield is one of the few businesses in that industry in the United States that is vertically integrated. So they actually entered the hog production business themselves. That is a highly volatile business. It's very prone to boom and bust cycles, okay? But all of a sudden now, what does Smithfield get to do with its excess production of hogs? Sends them to China. And this is going to do what to its income stream? It's going to smooth it out. It's going to have a more stable earnings stream, which should what? Command a higher multiple in the marketplace? Right. So you see, we saw a few things here, okay? So when we modeled Smithfield's income statement on this basis going forward, the EBIT margin increased from 4.9%, which implies on a discounted cash flow basis that the firm should trade at 13.3 times earnings per share versus its historical 8 times. So that's what we saw by smoothing out the income stream from Smithfield Foods. Okay? And then lastly, what I think is the most important slide is the sum of the parts analysis. So at the time of purchase, the market was deeply pessimistic. They'd had this botched IPO. Everybody hated the stock. Emerging markets were depressed. That was weighing heavily on the stock. WH Group owned 73% ownership of Shangwi. So that's where we get the $9.9 billion in the A-share market. That's the top line. And WH Group paid $4.7 billion for Smithfield. So when you combine those two, that implies $14.7 billion. WH Group traded at $8.9 billion at the time of purchase, a 39.5% discount. So we saw it on the screen. We thought it was curious. Then we did a little more digging. We liked what we saw from the industry, right? Demand was outpacing supply. We saw some really interesting things. We thought that was all supportive of the case to buy WH Group. And a simple sum of the parts analysis showed that it should be trading at a higher price. We thought that Smithfield Foods would stabilize its income, command a higher multiple in the marketplace, and that the market was discounting that. So that's how we got from the idea generation to actually making the purchase. And that's a good example of what we do every day. So we're running these screens, we're looking for curious things, and we're digging a little more. So that's it. That's from beginning to end how we manage business every day. And I'm happy to take any of your questions.
Is it a good time to invest?
I think it's always a good time to invest.
How do you feel about the oil and gas and commodities? And because they have corrected a lot. I mean, they just, in Canada in particular, like down 30-40%, which is commensurate to some of the numbers you showed us before.
Yeah, well, we've made some purchases recently. Do you want to tell them about some of the things we've done in the oil and gas space? And Scott runs our research process.
Sure.
So.
So what we focused on there in oil and gas was we've studied basically an analysis of oil price crashes in the past 30 years. And what's interesting about this environment is it's run in conjunction with declining growth rates in the emerging markets. So there's a lot of confusion and some faltering growth in the United States, or some evidence of it as well. So there's a lot of confusion as to the correlation between the collapse in commodity prices and economic growth itself. We happen to think that generally economic growth is somewhat stable in the U.S., even if it is declining in the emerging markets, and that the oil price crash itself is more idiosyncratic to oversupply. And so if you take that position, then these idiosyncratic oil price supply crashes are buying indicators. And if you look at the dividend yields versus the S&P 500, they've, among the super oil majors, they were at about 2.8 times the S&P 500 within the last 3 or 4 months. They've actually, that's a statistical outlier. That's only happens 1% of the time over the last 30 years. And so if you look at returns coming out of those periods, they've ranged anywhere annualized about 700 to 800 basis points above the S&P 500 from that point on for the next 5 years. So if you buy into, this idea that it's an idiosyncratic event, oil prices, commodity prices do crash on their own volition due to oversupply occasionally, then it is a buying opportunity. And so if you go in and you kind of take the basket of super oil majors and look at what the market is discounting, it's discounting a 33% cut to the dividend rate. That's how you get the 7% dividend yield on that basket of securities. And so we just looked at it historically and saw that Exxon and Shell and all these businesses have been through several of these cycles in the past, and they never had to cut their dividends. And the reason for that is they sell assets, they make cuts to their CapEx, they save money, they cut expenses, and they actually came into this event, this oil price crash, with cleaner balance sheets than they have in the previous cycles. So yeah, we own a basket of super oil majors. They're all the large kind of safer plays. We don't think we're sticking our necks out by much stretch of the imagination, mostly because they have diversified businesses too. So they're making money on the refining side, which is a big deal. It increases their cash flows and helps them weather the storm. So yeah, we are selectively we've been investing in oil stocks.
Thank you, Laurie. I just had thank you very much for coming to speak, and I had a question about your process. So you've described a process that, even though it didn't start at the macro level, you did a lot of macro analysis, and we've had speakers come through before who mentioned some of the risks or challenges around doing that. So what is it about your process that helps you gain comfort from putting that much focus on macro analysis?
Well, I mean, I would say there is no focus on macro analysis from the start. I mean, we're really just looking at numbers when we're doing the valuation metrics. Obviously, that comes up a little bit when you're modeling a stock because you have to choose the discount rate, right? And so that depends on what country or industry you're looking at. And we've seen those discount rates at times range between 8 and 13%, just depending. So even, value managers that say they don't make any macro predictions, if they're a global investor, I mean, they're having to do a little bit of macro research just to come up with which discount rate to use. And then if you're going to do any fundamental analysis at all, it's going to factor in. It has to. I would just say we do it really carefully. We try to, it's a little bit of art form. You're trying to paint a picture. So you're looking at what the numbers tell you, and then you're trying to figure out where the trade's going to go bad. So what are the numbers not telling you? You're looking for the holes in the argument. And so I would say after we do the metrics and we do the screens and all of that, it's just painting a picture. It's a little bit art. It's art and science. And I think investors who say they don't do that, I mean, they have to a little bit if they're using any bit of fundamental analysis, because macroeconomic factors play into your industry, your company. I mean, it's going to change the discount rate you use if you're modeling a stock. So they're all doing it, whether or not they say they do or not. I mean, don't you think, Scott?
Yeah, I mean, I think for us, the bottoms-up process is driving the bus, for lack of better words.
For sure.
But, when you buy a business that's located in a different country or has global operations, and you're signed up for all these macro risks, and you can either assess them or ignore them, but they're there. You don't want that to overtake what is actually going on, which is you're buying a business at a discount to its intrinsic value. That's the best way I would frame it.
Thank you.
Thanks for coming in. I have two questions. One's kind of personal, and one's for the entire group here. So last summer, I actually worked at a investment management firm that employs Templeton strategy, because the guy that founded the firm worked at Templeton Investments for 15 years.
Okay.
And one thing I noticed, this was my first buy-side stock picking experience. And after being in school, learning DCFs, when I got there, not only did they not have DCFs, they actually did not even calculate intrinsic value. It was all multiples driven. So PE,
I can see that.
P2P. So I'm just curious, you mentioned how you use DCF in your valuation. Is that what Sir John Templeton used, or was it something that you thought was...
He did use it. I mean, but like I said earlier, he said he had, 100 metrics he looked at. But the way he did it was that he made list of stocks using value line, and he was ranking them based off of metrics, and he was making those lists by hand. I mean, it was a totally different approach, but he did know how to use a discounted cash flow model, and he also was involved with us when we set up our investment process and creating our discounted cash flow model in our process. So, I mean,
Yeah, I think that what's interesting about Sir John as an investor was, and it goes back to those 15 attributes that Lauren had on that slide, he recommended being flexible. And what he meant by that was he had a number of valuation tools that he could employ. And so if you go back to one of his largest investments, it was back in the early 1980s. He had just basically cleaned house on Japan. He had been invested in Japan since the late 1950s. Japan took off in the 1970s. People started going into Japan in the 1980s. He was selling out of Japan and going headlong into the United States. So by the bottom of the bear market in 1982, he had 64% of the Templeton Growth Fund in the United States. And the reason he offered for that was U.S. stocks have never been this cheap in my lifetime, even in the Great Depression, based on replacement value. Mm-hmm. So of all the methods he could have used to look at U.S. stocks, even PE, I mean, the S&P 500 had a PE of 8 times. So it was appealing there, but he was using replacement value. So you never really could pin him down in terms of which valuation model he was beholden to, because he used a bunch of different ones. So if this manager you work with was more focused on multiples, well, that doesn't surprise me at all, because he used those too. And it's kind of what lessons or methods did that person take away from him? And we took away, we've tried to be flexible too. We don't know 100 different, valuation tools, but he also was a serious, investor at a very high level for 70 years. So.
But he did like multiples. When I started at 24, he was very careful in the way he set up my business. So I was running a quantitative strategy. It was not a quantitative fund, but it was a ranking process using metrics. And I was not allowed to sell a stock. We had a determined holding period, and it didn't matter what happened to that company in between the time of purchase and the end of that holding period, I couldn't touch it. And that was very wise of him, because he knew that I wouldn't be able to handle my emotions. I mean, I was 24 years old managing $30 million. I was actually managing $60 million because it was 30 million long, 30 million short. And the way we set it up was we were using metrics to rank stocks, and we were going long, really cheap stocks and short, really expensive stocks. And that can work if you're very disciplined. But there are ways to fine-tune that so that you can be even more successful. So if you take those metrics and then you do the discounted cash flow overlay, and then you learn how to do really appropriate fundamental analysis, you can improve your results even more. And that was a part of the process. So I kind of started out managing this fund with guardrails. I can start like bowling with bumpers. He had me out there. I was managing money. I was learning how to handle my emotions. I was bowling with bumpers. And then gradually he took down those bumpers, and we started developing the process that we manage here today. In 2006, we added the discounted cash flow model and the fundamental analysis. And he said, I think you can handle it now and you're good to go. But starting off, it was metrics. He liked ranking on metrics.
Yeah,
But you have to be really consistent doing that. I mean, I would say you can't just have this strategy where, you're running Joel Greenblatt's strategy, you're getting your stocks off the computer screen, and if something draws down, you're selling it. I think if you want to be successful using that type of metric strategy, you have to have a defined holding period where you're not going to go in there and touch anything, during that period. You're not going to override the system.
Right.
Do you see what I mean?
Yeah. The only reason why I ask is because it's really tough for a student, starting, I guess, investing, to not have the concept of intrinsic value, and when you're just looking at PE, because just conceptually, if you don't calculate intrinsic value, then what are you comparing the market price to? So that's just a personal question that I just wanted to ask. And the second question is, my roommates and I, we talk about stocks here and there very frequently. And there are some stocks that I found very interesting, but are down because of macroeconomic factors. So great brand, great businesses, but stock price is punished because of macro things. And I thought it's a great buy, but my roommate was basically saying that it was really linked to Brazil. He was very short on Brazil. So what he's saying is, why would you buy? Brazil's tanking. But in my opinion, because the business is so great, it will come back once macro trends, it flips. So what do you think about catalyst-driven investing? So although you have value investing principle, but you add that catalyst component to make sure that it will eventually materialize.
I mean, we do some of that too.
When you say catalyst, you mean a bottoms-up catalyst or like a macro catalyst? Or do you just need a
He's
catalyst
talking about a
period
macro
before you
catalyst.
I guess catalysts in general.
Catalysts in general are great
Yeah.
when you
Great.
can find them. I think we had found one in WH Group just with the effect of the exports and how that filtered back into the value of Smithfield, even though it was embedded in the business itself. But in reality, when stocks get cheap enough or discounted enough, they discount so many different things going wrong that those are catalysts because they don't have to go wrong. What if things are just kind of bad or just kind of so-so? Well, stocks can get cheap enough to where if things are only so-so and not awful, you'll make a lot of money when people think, oh, well, this isn't so bad. So sometimes it's just the nature of the catalyst. But if you can pin your sights on one thing and say, I think this is going to happen, I think it's probable, this is why the stock will re-rate, that's great. But sometimes stocks get so cheap that they're cheap under so many different scenarios, they make sense. It's just common sense to own them.
But we definitely use catalysts on the short side.
Yeah, you need one. You need them
Yeah,
on the short
you
side.
need one on the short side. Shorting based on valuation is a tough road to hoe. I mean, it's hard. So we use a catalyst there. And it's very successful for us.
Okay, thank you.
Hi, thanks again for coming. Couple of questions, one about investing, one about funds. So I noticed that in your last step, you do a second check for industry concentration, country concentration. So what are your views around diversification and how many positions you like to hold, minimum, maximum?
Okay, no more than 50% in any country, currency, or industry. We have about 35 stocks in our portfolio. On the short side, we'll have 100 positions in the portfolio. That's just something we've learned over the years. I used to run a portfolio that was 25 short positions, and we shorted just based on valuation, and it was tough. It was very tough. So I feel like most Templeton managers are no more than 50% in any country, currency, or industry. That's kind of like the Templeton way.
Okay, and the other question was, you talked a little bit about the difficulty of dealing with investors, them putting in money, taking out money at the wrong time. So do you put any policies or stops in place to kind of condition them a little bit better, and what are they?
Well, it depends on the vehicle they're investing in. But we do a really thorough job of vetting investors going in. We don't have many investors. We manage, $200 million. We have 12 investors. And like I said, when I meet with investors, I say this is a partnership. And we turn away investors. So we've had investors come to us where it's clearly just not a good fit. And we just say, I just don't think it's going to work. We've had investors come to us at the wrong time when it was really hard to find a good value stock. And I've said, I don't feel like I can be successful with your capital right now. Can I call you when the market gets bad? Now, chances are, I'll call them when the market gets bad. They're not going to write me a check. And I know that, but that's where I've come just on my business, is that it's so disruptive to have people coming and going, and they want your time if they get really scared in the market. So we just vet it really. We do a good job of vetting investors. In fact, we don't even have the name of our company on our door. All we have is a sign that says trouble is opportunity. That's it. And when they come in and they're like, I don't get it. What does that mean? And we're like, oh, well, there's an advisor down the street. You should go talk to you, because we're probably not going to be a match. And then some people come in and they're like, oh, I love it. I love value investing. I get it. Then we know it's a good match. But I mean, it's very hard managing clients, their expectations. I tell my clients I worry way more about your money than I ever worry about mine. I'm fine with value investing. I'm fine investing in a downturn. I don't worry about it at all. I worry about your capital. I worry about if you're worried at night. I worry if you're stressed out. And so it's hard. That's the hardest part of the job. I think any value manager will tell you that for sure. We were having dinner with Jean-Marie Avallard about a year ago, and he said, oh, I just, why can't we all manage closed-end funds? Right? So that's really a dream. You have capital, you don't have to worry about it. It's a problem.
Thank you.
Good evening. I also had 2 questions, one on your portfolio and one more personal for you. On your portfolio, you showed us at the beginning all these down crashes and corrections, which affects most people. And you said that you guys don't invest unless you can see a 50% upside. I was wondering how else you manage the downside risk to reassure your investors as well.
Well, if a stock declines more than 20%, we're definitely meeting on it and talking about it. But if it's in a big market correction and it's declining in conjunction with the market, we don't even worry about it very much. We don't really have those discussions.
I think the other piece of that is if you manage more on an absolute value basis, if you're sticking to your intrinsic values, and you're also selling stocks as the market goes higher. And that, if you're following that discipline, is building up your cash reserves as well. Hopefully the right time, which is as the market's getting too high. So there's kind of a self-correcting mechanism within that process as well.
That happens organically. So by the way, when companies are starting to reach their intrinsic value, you usually have a few of them in the portfolio if the market's becoming kind of pricey to overpriced. So you're selling those positions. But it's harder to find a value investment. So instead of it taking 2 weeks for us to identify a position, maybe it takes us a month. Things start to really slow down in the portfolio and cash starts to build. So hopefully that's organically happening in the portfolio and you're sitting on cash during a correction. So as the market's becoming more expensive, it's harder to find value investments. The process slows down, cash starts to build. It's taking you longer to find investments, and generally that's when the market is starting to correct. But going back to that discount and cash flow model and the question that somebody had about how they'd worked for a Templeton protege. So the discount and cash flow model is really helpful on the exit strategy. So remember when I said Sir John first set me up, I managed, it was a quantitative ranking process and it was a defined holding period. So at the end of the holding period, we just ditched the whole portfolio. But to improve the results, we added discounted cash flow model and fundamental analysis. Discounted cash flow model is important on the front end, right? Because you're identifying margin of safety, but also on the tail end because you're quantifying when you're going to exit the position. Now, I think a lot of managers mess up in this area. If you meet with a manager and you say, what is your exit strategy? And they're like, I don't really know. That's an issue. So when our companies approach our calculation of intrinsic value, we start to think about liquidating them. All right, so ideally, we've identified a stock, we've invested, it's risen to our approximation of intrinsic value, and we're selling it. And I tell my customers, look for us to be in this range. Like when the company has left our approximation of intrinsic value, it's another investor stock Maybe it's a growth investor or something like that. But if you see me consistently not playing in the range between undervalued to our approximation of intrinsic value, you should fire me because I've strayed from the strategy. So this is just the area where we consider ourselves good at. And the discounted cash flow model is really helpful to us because it helps us quantify when we're going to sell. If you don't have that mechanism, if you don't have the intrinsic value calculation in conjunction with the multiples, then I guess you're selling based off the multiple, but the intrinsic value calculation is extremely helpful to us. We have a spreadsheet up in the office at all times, so it has a list of our companies and our range of intrinsic values, and we're constantly monitoring them basis versus where they are. And that helps us manage the investment process too. So how many companies do we have trading, near intrinsic value? How aggressive do we need to be researching companies? How much time do we need to be spent on researching what's possibly coming down the pipeline for us? Do we need 5 new positions? Do we need 1 new position? I mean, it just helps a great deal, I would say. Don't you, Scott?
Yeah.
And my second question was on a more personal level. A lot of the value investors that came to us said that one of the biggest things is your mindset and your ability to control your emotions. And I was wondering, for a family fund, how that affects the dynamic and how, as you said, able to step away from the market as a family together in that sense.
You mean as Scott and I being married and raising children together?
Exactly.
It's awful. It's hard. But it's so hard. When we come home, there's no separation from work for us because when we're at home, we're talking about the portfolio. When we're in bed, we're talking about the portfolio. It's hard. My mom's always like, I told you not to go in business with your husband. The great thing about it is that Scott does most of the analysis in the office, and I'm really looking at the portfolios and managing the business. He's the brains, I'm the beauty, hopefully. But what's great about it is that we know each other really well. And so I'm very good at putting on a trade in a really scary market. I'm really good at that. I don't know if that's in my DNA. I mean, there are some studies that suggest that could be an inherited thing, that it could be in somebody's DNA, whether they're great at that or not. But I'm good at it. So I know that in a scary market, when Scott comes in and we're talking about stock ideas, I can read him like a book. And so that is very helpful when we're deciding how to handle the portfolio. But it's hard. But it would be hard to be in this industry even if you weren't working with your spouse. It's just a hard industry to be in. What's great is that we've had some of the best experiences together. We've had some, when most of you won't get to work with your spouse. So you do something really great at work and they're not there to share it with you. And you go home and you try to tell them about it, how great it is, and they don't get it. Well, Scott and I have those experiences together. So that's really awesome.
Thanks very much.
My question's about diversification as well, and I don't want to come across as redundant, so I'm going to try to kind of cater it to, I guess, the value investors starting out. So for young value investors starting out, and going back to your point about holding a portfolio that has enough or adequate industry exposure, are students starting out then, are they needing to wait in order to invest their capital, given that often students have a low amount of capital? Are they needing to wait to invest in a diversified portfolio? Or if we do know the company well enough, and if we know that the management is sound, and that we can see that there is a potential to realize a catalyst, are we okay to invest one by one in the companies that we like?
Yes, absolutely. Like my biggest advice to any of you in the room is start now, start with real money, even if it's just $50. Like it has to be real money. You can't read about it in a textbook. Mm-hmm. You should keep a journal of your positions. My dad does that. He has an old school ledger and he can go back and say, look, I bought this in like 1982 and I was either profitable or I lost money on it. And I mean, that's the most important thing. You'll get to a bigger portfolio and you can think about diversification, all of that as you grow. But the most important thing for everybody in this room is start now, start with real money and do it immediately. Don't you think, Scott?
Definitely agree.
And then in regards to making mistakes, I told this story earlier. When I graduated from college, I mean, I started picking stocks when I was 7 years old. So I've been picking stocks my whole life. My dad would let me pick one stock a month. And I grew up with stock certificates wallpapering the bedroom of my room. That was my reality. But when I grew up, I kind of got away from that somewhere in college. I wasn't very interested in that. I was interested in other things. And I graduated from college and I went to work for Morgan Stanley, and I called my dad and I borrowed some money from him because somebody gave me a hot tip. And I called him. I'm like, Dad, I've got this great investment. Can I borrow this money? And I think it was $500, which was a lot of money for then. I mean, my first salary was $17,000. So things have changed. But I borrowed $500 from my dad, I think it was. And I had to call him like a month later and tell him I'd almost lost it all. And I was so nervous about the phone call. And he said, great, that's awesome. And I was like, did you hear me? I lost the money. And he was like, that's exactly what I was hoping would happen. And I was like, what? And he said, well, first of all, I wanted you to learn that there's no such thing as a hot tip. You have to do your own research. And this was a really cheap lesson for you to learn. And it was a lesson I learned with real money, with borrowed money. So I learned it. I'll never take a hot tip again. So you should start now. You should start with real money and do that. And the other thing about doing your own research is that in a market sell-off, if you haven't done your research, if you've relied on somebody else's research and you get really nervous, that's good. You start looking to other people to see what to do because you don't have the confidence to stand pat in that investment. So it's really critical to do your own research, because if you've done your own research, then you're more confident in the position, and it just helps you be a little bit more secure in a market sell-off. If you've taken a tip from somebody else or taking somebody's advice, you're going to start looking to other people in the market to see what to do in a sell-off, and they're selling, so you're going to sell. So that's my advice there.
Thanks.
Hi, thank you for the speech. So I have always been an admirer of Sir John Thompson's buy the maximum pessimism philosophy. Given this thinking logic, what's your thoughts on the current Chinese stock market, considering it's at the lowest point, which everybody is basically pessimistic about the stock market right now, and facing the regulations like constraints? Even in the WH example you gave, like, were you thinking anything about the systematic risk you were exposing to, considering the characteristic of the Chinese stock market at that time?
We're always thinking about that, for sure. So would I have a portfolio of 50% Chinese stocks right now? No, I wouldn't. But we have some exposure to that market, and they're in really cheap stocks. So that's how we get comfortable with that. We have some exposure to Brazil right now. Not much. What do we have? One position in Brazil? No? Two. Estasio and yeah.
Thank you.
Okay, our time is up. Last question from me. What is the most important lesson you learned in investing over the last 15 years?
Gosh, the most important lesson. I don't know. They're all important to me. Buy low. I mean, that's a good one, right?
Patience.
Buy low. Patience? I don't know. That's not what I would say. That's what he would say, patience. I would say to remove yourself from the market. So quit. Don't watch CNBC. That's my piece. That's my number one lesson. Don't watch CNBC. Don't look at your portfolio every day, and exercise daily.